So, welcome back to class. In chapter 20.1, we were looking at one numerical example, and we were already able to derive central results. One central result was that in case that the law of one price holds in the medium run, it is the case that the exchange rate regime doesn't matter. The real exchange rate will be the same in a fixed or in a floating exchange rate regime. However, the adjustment process after a shock occurred towards this equilibrium might be long and tough in a fixed exchange rate system or fast and soft in a floating exchange rate system. So in this part, I would also like to come up with a more formal model, and we will use some elements which you know already. Let's have a look into the equations. The first equation, this is the goods market equilibrium condition. Left-hand side, goods supply. Right-hand side, the demand for domestic goods, which stems from consumption. Consumption depends on disposable income, as well as the autonomous component of consumption. Then we have here the investment function, which depends negatively on the nominal interest rate. Then there is government spending, which plays a role. Net exports depend in a negative way on domestic GDP. In case that domestic GDP increases, it will be the case that the consumption increases, but we are consuming domestic goods, but also foreign goods, so that imports increase in case that the domestic GDP is up. Therefore, there is a negative sign in front of the Y term. In case that foreign GDP is up, then the foreign economy will consume more. They will also consume more goods from our economy, and therefore, when the foreign GDP is increasing, the demand for domestic goods increases. There is a positive spillover effect from the foreign economy on the domestic economy. Furthermore, it is the case that the demand for domestic goods depends positively on the real exchange rate. This is very important that we make some adjustments here, like there is a positive sign in front of this expression because we are using the price notation of the nominal exchange rate, and therefore also the real exchange rate had to be adjusted compared to the textbook. So when we look at equation 11, it becomes clear that in case that the exchange rate increases, so a depreciation of the domestic currency occurs, demand for domestic goods will increase, and therefore the IS curve will shift to the right. In case that the exchange rate decreases and an appreciation of the domestic currency occurs, then the IS curve will shift to the left. We have a money market equilibrium condition. So here, once more, it is assumed that the central bank is trying to stabilize the nominal interest rate. And maybe it would be a better label to use the label interest rate line because the LM curve is a horizontal line here. Then for the supply side of the economy, we are looking at one version of the Phillips curve, and we use the version where the inflation expectations are anchored so that the wage setters believe that the inflation target of the central bank is reached. The wage setters are setting their expectations according to the inflation target of the central bank. When we look at the graphical representation of this model, like in the upper part, we have the downward sloping IS curve, also the interest rate line, which is given here. And in the lower part, it is the case that we have an upward sloping Phillips curve. The Phillips curve is upward sloping because we are working in a diagram where we have the change in the inflation rate on the vertical axis, and the Phillips curve is upward sloping because of the fact that we work in a diagram where we have the GDP level on the horizontal axis and not the unemployment rate. Therefore, the Phillips curve is upward sloping. We will assume that a negative demand shock occurs, and this should be in line with the chapter so far. So the central bank changes the exchange rate from 150 to 125 so that an appreciation of the domestic currency occurs. Exports decrease, imports increase, net exports decrease. And you know that the real exchange rate is included in the IS relationship. The real exchange rate also decreases, and therefore this negative expenditure switching effect occurs. So exports decrease, imports increase, and the demand for domestic goods decreases. The IS curve shifts to the left. This is highlighted on slide number 24. The IS curve shifts to the left because of this appreciation of the domestic currency. Therefore, the economy ends up in a recession. The GDP decreases compared to the initial situation, and hence the inflation rate will decrease. Inflation rate is lower compared to situation A. Let's summarize the effects in the short-run equilibrium. The negative demand shock leads to a recession. So GDP in situation B is lower than the situation in A. The unemployment rate is higher than the natural rate of unemployment, so that the inflation rate decreases. Let's assume here that the inflation target of the central bank is equal to 0%. So central bank's objective is a strict price stability. Therefore, the realized inflation rate will be negative. The inflation rate in period B is smaller than the inflation target, and the inflation target is equal to 0. So in scenario B, the inflation rate is negative. The domestic goods prices will decrease so that the real exchange rate increases again. So when the real exchange rate increases, over time, the IS curve will shift back to the right. This is highlighted in the next slide. So the IS curve shifts to the left because of the shock that the exchange rate decreased. And now the inflation rate is negative. Goods prices start to decrease, and therefore the IS curve shifts back to the right. IS curve shifts to the right because goods prices decrease, and we get a new IS curve, IS2, and it's also the case that in the end GDP is on the initial level. The nominal exchange rate has not changed, and also the inflation rate is back on track. Inflation rate is once more equal to the inflation target, so that inflation rate in situation C is also equal to 0. So after the adjustment process has taken place, the real exchange rate once more is at the level of 1. So in the first step, the nominal exchange rate decreased from 150 to 125. Due to this mistake of the central bank, a negative demand shock occurred. And then it is the case that the Swiss price decreased from the level of 12 Swiss francs per Swiss good to the level of 10 Swiss francs per Swiss good, so that in the end, the real exchange rate is once more at the level of 1. When this adjustment has taken place, the economy is back on track. GDP in situation C is equal to GDP in situation A. So once more, we can have a look at these main takeaways, this time by looking at this macroeconomic model. It is indeed the case that the economy had to go through a recession. This recession is tough because unemployment rates are higher than the natural rate of unemployment. And it can also take some time because of the fact that the economy is going through a phase of deflation. And phase of deflation implies that each and every company has to lower the goods price, but also each and every wage contract has to be adjusted with a lower nominal wage. And hence, this will take some time. This process needs some time. In a floating exchange rate system, of course, it would be easier to adjust the nominal exchange rate back to the right level of 150, and then the shock could be digested very, very fast. In the following, we can elaborate a little bit on the question, like in times of Corona, why is this analysis relevant in the real world? Let's assume that we are looking at two countries, Denmark and Italy. They are both small open economies, of course small compared to the rest of the world. Both countries have fixed their exchange rates. Like Denmark has fixed the exchange rate at 7.44 Danish krona for 1 euro, and Italy has fixed the exchange rate at the exchange rate 1 Italian euro for 1 European euro. Let's assume and interpret that the corona shock is a negative demand shock, and let's assume that the autonomous component of consumption decreases so that the IS curve shifts to the left. What kind of instruments can be used by Denmark and what kind of instruments can be used by Italy to digest the shock? So Denmark has still a nominal exchange rate as an instrument. So Denmark could, in case that they want to, abolish the fixed exchange rate system or realign the exchange rate and implement a higher exchange rate so that a depreciation of the Danish krona occurs. And then the IS curve would once more shift to the right and the Danish economy could get out of recession. But Italy doesn't have this option. So Italy has adopted the euro. So there is no nominal exchange rate in place anymore. So Italy cannot use the nominal exchange rate as an adjustment process. So for Italy, the only way out of crisis would be to go through the phase of deflation, and this will be a long and tough adjustment process. So we arrived at chapter 20.2, exchange rate crisis under fixed exchange rates. Also here, let's sum up the main takeaways. What are we going to learn? We learned that central banks have several options to deal with a speculative attack, a speculative devaluation attack, but these options might be costly. One option could be to let it flow, like to switch from a fixed exchange rate system to a floating exchange rate system, but then the central bank or the government could lose reputation. One answer could be to raise the interest rate. This could lead to a recession. Furthermore, one option is that the central bank or the politicians are talking to the investor, but the big question is whether they listen and whether they believe the central bank and the government. Another option is to intervene at the foreign exchange market. One problem with this option is that in the end, the central bank could run out of reserves. And in the end, we will also look at one example in history where this occurred, where one central bank was running out of reserves. Let's clarify some terms. Depreciation versus devaluation. In case that the currency loses its value in a floating exchange rate regime, we call it a depreciation. When a currency loses its value in a fixed exchange rate system, we call it a devaluation. So when the central bank or the government changes the exchange rate in a fixed exchange rate system, but keeps a fixed exchange rate system in place, then we call this change a realignment. For example, in period T, there is a fixed exchange rate system in place. The exchange rate is fixed at 120 Swiss francs per euro, but then in period T plus 1, a change occurs. Suddenly, the exchange rate is fixed at the level of 130 Swiss francs per euro, but still we have a fixed exchange rate system in place. Then we call this movement here like a devaluation and also like a realignment. But of course, like one option is always that the central bank or the government could switch from a fixed to a floating exchange rate system. This is also always an option. So why could it be necessary that a devaluation has to occur? One reason could be like that the internal conditions within the economy, they demand a change of the real exchange rate. So the first reason is a change of the real exchange rate could improve the economic situation of the economy we are looking at. For example, after a negative demand shock occurred, like a real depreciation could lead to a positive expenditure switching effect and could pull the economy out of recession. Then exports would be up, imports down, and the demand for domestic goods would increase. And we have two possibilities, like how this devaluation can occur. The first possibility is that the economy goes through a phase of deflation, so that the adjustment of the real exchange rate occurs via a decrease in the domestic goods prices. The second option is that a realignment occurs and a devaluation takes place. So adjustment takes place via the nominal exchange rate. The first solution will be long and tough, and the second solution will be fast and soft. Let's have a look at the second reason why a devaluation might be necessary. It could be the case that the real exchange rate is too low. When the real exchange rate is too low, exports are too low, imports are too high, so that the economy is running a current account deficit. But why could it be the case that the real exchange rate is too low in the first place? Let's look at one country which has a very poor track record with achieving price stability. And this economy fixes its exchange rate to a stable currency. For example, at one point in time, the Argentinian central bank and government, they fixed the Argentinian peso to the US dollar in order to import price stability. However, if it is still the case that the inflation rate in Argentina is larger than the inflation rate in the US, then it will be the case that the goods prices in the domestic economy, the goods prices in Argentina, increase faster than the goods prices in the US in the foreign economy. What are the implications for the real exchange rate? This is highlighted in equation 17. So the Argentinian goods prices increase faster compared to the Americans. And therefore, we have this effect here on the real exchange rate. The real exchange rate decreases and is too low. And then, of course, one idea could be to perform a realignment to devalue and adjust the nominal exchange rate. A third reason why a devaluation can take place is that the financial investors expect a devaluation. Let's go through this reason and assume that in the initial scenario, the foreign interest rate is fixed at the level of 4%. And also the investors believe that the exchange rate system is stable. So in period T, the expectations are that the exchange rate is stable, the exchange rate is equal to the fixed exchange rate. Therefore, our UIP condition, uncovered interest rate parity condition, becomes domestic interest rate is equal to the foreign interest rate. And here it is the case that the agents expect that the exchange rate is stable, that the exchange rate does not change, so that the last term of the UIP condition drops out. The domestic central bank has to set the domestic interest rate also to the level of 4%. This is the initial scenario. So the foreign central bank has set the interest rate to the level of I star equal to 4%, due to the fact that the investors believe that the exchange rate system is stable. The investors do not expect a devaluation. The fraction in this UIP condition is equal to 0 and therefore does not matter. The domestic interest central bank also sets the interest rate to 4%. Then a shock occurs and suddenly some investors expect a devaluation. The textbook argues as follows. Let's assume that 75% of the traders expect no change in the exchange rate, but 25% of the traders expect the exchange rate to increase by 20% within the next month. The weighted average of the exchange rate expectations are 75% of the market expect a 0% change and 25% of the market expect a 20% change. So here the weighted average of the exchange rate expectations, this is equal to 5%. So the average investor demands a 5% compensation for holding domestic assets, but on a monthly basis. What does it mean for the yearly interest rates? So we measure interest rates per annum. We have to multiply through the exchange rate expectations by 12, and hence it is the case that the domestic central bank has to increase the domestic annual interest rate by 60 percentage points. So the domestic central bank has to increase the interest rate to the level of 64%. Then, once more, the UIP condition holds in the following form. Domestic interest rate is at the level of 64%, foreign interest rate is at the level of 4%, and there are exchange rate expectations of 60% within the next year. Such a high level of interest rate will of course kill the real economy because of the fact that this will affect investment and will cause a recession. When the central bank is forced to keep this interest rate level in place for a longer time period, then the economy will end up in a recession. When the investors take into account that this very high interest rate will lead to a recession, then it is even more likely that the central bank will abolish the fixed exchange rate system and switch to a floating one. This implies that a few days later, the relationship of expectations within the market will not be 75 to 25% anymore, but maybe 50-50. So that the central bank has to increase the interest rate even further. In the textbook, you can read about the crisis in the European exchange rate mechanism system in the year 1992. And there, Sweden tried to defend the fixed exchange rate and increased the overnight interest rates to a level of 500%. And guess what? The Swedish central bank was not able to defend the Swedish krona against the speculators. The exchange rate system broke down and the fixed exchange rate system collapsed. I would like to conclude in this chapter and raise some critical remarks with respect to the textbook. So the textbook argues as follows. There is group 1 and 75% of the traders expect no change in the exchange rate, while group 2, like 25% of the traders, expect the exchange rate to decrease by 20% within the next month. Therefore, the average investor demands a 5% compensation for holding domestic assets on a monthly basis. This is the assumption made by the textbook. But when you really think about it, it is the case that there is no such thing like the average investor. The average investor does not exist. In case that the central bank implements an interest rate of 64%, then Group 1 investors would stay invested in domestic assets, but Group 2 investors would sell domestic assets because the increased domestic interest rate just compensates for the average expectations. But the expectations of Group 2 are much more pessimistic than that of the average investor. Even the increase of the interest rate to the level of 64% is still not large enough to compensate for the expectations of Group 2 agents. So please be a little bit careful when you read the textbook, and so please be a little bit careful and also critical when you read the respective chapter in the textbook. What kind of actions can a central bank perform to defend against a speculative attack? One option is to increase the domestic interest rate. One option is to talk to the investors and try to convince them that devaluation expectations are not justified. And a third option is to intervene at the foreign exchange market. Let's stick to this example of the textbook and assume that Group 2 investors would even sell domestic assets when the interest rate is at 64%. So the supply of domestic currency at the foreign exchange market increases and the demand for foreign currency increases because these investors of Group 2, they want to get rid of out of investments in the domestic economy and they want to invest in the safe haven in the foreign economy. So there is some pressure that the exchange rate increases. Here's a slight mistake, increases. So there is pressure that the exchange rate increases and a devaluation occurs. So the central bank has to increase the supply of foreign currency and has to demand domestic currency. So the central bank will continuously lose reserves by this intervention process, and at some point in time, the central bank will run out of reserves. The cellar is empty, like the basement of the central bank is empty. There are no reserves anymore. So this line of argumentation is very crucial. So let's go back once more. In case that the investors are leaving the domestic economy, then it's a case that the domestic currency will be weak. There is some devaluation pressure, but the central bank has promised to keep the fixed exchange rate in place. The central bank has to defend the fixed exchange rate and has to supply foreign currency because foreign currency is strong, and has to demand domestic currency because domestic currency is weak. Since the central bank is increasing the supply of foreign currency, the central bank is continuously losing reserves. In the end, we said that the basement is empty. It is the case that there are no reserves anymore. Can that happen? Is it really possible that the central bank can run out of reserves? Let's board the time machine and go back to August 1993. Please have a look at this article here from the Bild-Zeitung. I'll try to read it loud, first in German language, and afterwards I will translate the main parts in English. So, the Bild-Zeitung is writing: 108 Milliarden verloren. Frankreich Bank pleite. Paris. Die französische Staatsbank ist formell pleite. Sie hatte letzte Woche alle ihre Devisen hergegeben, um den Fonds gegen die Spekulanten zu stützen. Auf Frankreichs Devisenkonto lagen einst 103 Milliarden in Dollar, D-Mark und so weiter. Jetzt ist das Konto mit 2,8 Milliarden überzogen. Das Geld pumpt die Bundesbank. Notenbanken gehen nie wirklich pleite. Immer gibt es andere Notenbanken, die ihnen Devisen pumpen. Außerdem können sie immer wieder Geld nachdrucken. Great. Let's translate and come up with an Exec summary. The title of this article is 105.8 billion lost. French central bank is bankrupt. The French central bank lost all its foreign currency reserves, which was denominated in German marks and US dollar, because it was intervening in the foreign exchange market. The currency reserves were previously on the level of 103 billion. Bild does not mention the currency units. Maybe it was French franc, maybe it was German marks, maybe it was US dollar or potatoes, I don't know. But these reserves were completely used in order to defend a peg. So these reserves were used by the French central bank to defend a fixed exchange rate between the French franc and the German mark. So this article highlights that it can be indeed the case that a central bank is running out of reserves, that in the end the cellar of the central bank is empty and there are no reserves stored in the cellar of the central bank. What was the setting in the year 1992 and 1993? In this time period, the German economy was in a boom. The reunification occurred a few quarters ago, and therefore a tremendous expansionary fiscal policy is implemented to boost the infrastructure in the eastern part of Germany. The German economy is in a boom, the inflation rates are pretty high, and the Deutsche Bundesbank has raised the interest rates to very high levels in order to fight inflation in Germany. While Germany is in a boom, all other EU countries like France are in a recession. The main reason is France did not have a reunification. And hence all other economies, they suffer from a low GDP growth and high unemployment rates. The inflation pressure is low. But due to the fact that the German Bundesbank has implemented a very high interest rate, also the other central banks have to implement very high interest rates, and this is not in the best interest for all the other EU countries. all the other EU countries are in a recession, so that a low interest rate level would be appropriate. And due to this gap between the interest rate implemented and the appropriate interest rate level, investors started to speculate against the French central bank. The speculators started to speculate against the fixed exchange rate system and started to speculate against the French franc. In the end, also here, the French central bank needed to abolish the fixed exchange rate system and switched to a floating exchange rate system. I would like to stop here, and I think that we have gained very valuable insights. So please take some time to digest. Have a nice day. Bye bye.